Hello, everyone. Welcome to this week's episode of Stella Vision, Stella Rising's weekly marketing update with the news you need. I'm Marlia Clark, CMO. Thanks so much for joining us. We have struggled a little with power outages here in the Northeast this week, but we're all hoping the connectivity sticks with us today because we have a great presentation from Brandon Heagle, our Chief Digital Officer, who is primed to discuss what's happening in the digital and e-commerce landscape, but especially focused on pushing past plateaus for brands. It's something we know is of interest to so many of our clients. He's taken a deep look at how brands can expand beyond their current audiences, diversify their media for brand lift, and really critically, how to measure media returns in a way that promotes growth. As always, please submit questions as we go. We will answer as many as we can, but please feel free to reach out to Brandon, to me, anytime. We'd love to continue the conversation in person. But right now, let's get started. Hey, Brandon.
Hey, Marlia, thank you. Oops, sorry about that. Well, good morning, everyone. Happy Friday, and thank you, Marlia, for that introduction. So here we are with episode 15, where we're going to be talking about pushing past plateaus and looking at continuing growth for the many brands out there today. Before we get started, we wanted to do an updated look at what's really been happening based on the COVID-19 period. How has it impacted consumer behavior? What have we seen? For those of you that have been attending the Stella Visions regularly, some of this will be refreshed information. For some of you that are joining for the first time, hopefully it's reflective on what we're seeing and is some good information for you as well. But ultimately, COVID-19 has altered online behaviors across the board as initially consumers adjusted to their new normal of being quarantined and social distancing. Obviously, that meant spending a lot more time at home, and that changed how they ultimately, and we were, I should say, were kind of behaving, right, as consumers. So the first thing that started almost initially, immediately when the Shelter-in-Place Act came in place, is we saw web traffic increase, right? People were spending more time online. They were connecting more regularly. And so there was an immediate spike, even going back to kind of February, March. And that's really held consistent, plateaued, anywhere from 30 to 40% of an increase in web traffic. And that's really just people continuing to spend more time online. And well, what are they doing while they're online? They're consuming more media, especially social, video, gaming, really things that are helping them kind of pass the time and stay connected, right? In general, that's been the trend of what's been happening. As the world has started to open up a little bit, some of these things have come down a little bit, but for the most part, it's kind of stayed at a new kind of elevated normal level. Online spending has increased. So the latest projections are about an 18% growth in e-commerce for 2020 over last year. And really that makes sense, as people weren't able to go out into the physical world, or were purposely restricting the number of trips they were taking in the physical world because they didn't want to take health risks. People figured out that they had to buy things online and get them delivered to their homes in a safe manner. And so obviously there's been a significant uptick there. We'll talk about some of the categories that have benefited most from that, how that's changed over time. But for the most part, we're seeing a lot of that brick and mortar, purchase behaviors has shifted online. Well, although not fully recaptured. The in-shop store shopping experience is still hard to fully replicate. And so that's something that we'll be watching over time. In addition, people are investing more time messaging and socializing, online. So Facebook had seen an increase in their messaging app by about 50% and seen video calling double in some markets. And again, people weren't able to go out and interact physically, so they were doing so virtually. That, again, is in certain markets, as people have gotten a little more lax and more comfortable going to social distancing parties, hopefully not super spreader parties. They are kind of getting a little more human interaction. So that's come down a little bit, but for the most part, these were the first major shifts that we saw happen, and they've stayed at elevated levels. If we look a little bit more closely at the e-commerce growth, it was a rapid initial shift. Based on Forbes, we saw that ultimately e-commerce grew more in the first 2 months of the pandemic than it had in the past 10 years combined. I mean, it was a considerable jump. And ultimately, again, that's to be expected, given that people weren't going into the physical world. The one thing that we are seeing, though, is that even though eventually things will return to normal, eventually, we'll have managed through the pandemic and we'll get back to a brick and mortar retail shopping experience, It is expected that e-commerce is going to stay at an elevated level, and that a lot of demographics that had changed their purchasing behaviors are going to stay shopping digitally and online and through e-commerce more than they were prior, because the pandemic became a catalyst for new trial. Especially some of the boomers and some of the elder demographics that weren't necessarily as comfortable shopping online or weren't doing it regularly, or weren't doing things like buying groceries online because their whole lives they went into the grocery store. We're expecting some of that to carry over. And so digging a little deeper into that to get an understanding of how kind of consumer retail channel shifts have changed, this is a look at a weekly index comparing retail sales by retail channel for 2020 compared to last year in 2019. And for the most part, we see pretty similar, consistent shopping behaviors in terms of channel. This goes back to April. You can see online is indexed high in the dark purple, as well as home improvement. And they've really continued to lead the way. Office started to have an uptick as more and more people work from home. But I think the thing that kind of stands out that's the newest information to see is as stores are starting to open back up, you see some of the places that were hit hardest, like bodegas, like beauty stores, like gas and C-store. Those places are starting to tick up a little bit, which is showing a little bit of a return to normalcy. When Sephora and Ulta were closed, for instance, looking at beauty, you're seeing numbers 4, 5, 6. You couldn't really go in store to purchase. Now we're getting into the 80s, towards the middle of July. And that even goes higher in the forecasted July 19th date, where it goes 104, right? So, I'm sorry, 103. So we're starting to see that, things are starting to get a little bit back to normal in terms of the retail sector. We'll still somewhat holding consistent with more online, more, home improvement, and people making less trips with buying more volume to minimize their store exposure. It's starting to kind of normalize a little bit and get a little bit back to how things were. But again, this is going to be something to watch as, we see different markets and the pandemic ebb and flow in terms of case counts. It's going to really be a local issue to monitor. So from our friends at Google Shopping, they share with us, kind of what's happening in terms of sector level search volume. And so this is a great way for us to get a sense for, by kind of category, what's happening in terms of overall market demand. So looking at the search volumes, we can see this shows kind of going back to January through the third week of July, how kind of search volume was kind of ebbing and flowing across different categories. For the most part, we've seen a consistent trend from the beginning, which is that demand has really continued for kind of everyday necessities, essentials, utilitarian items, and things that help kind of solve boredom, whether it's entertainment. Fitness has certainly been up there. You can see it still leads the charge in terms of fitness and sporting goods, followed by home and garden, which we just talked about, with on the previous slide, seeing the home improvement retail sector still indexing very, very highly to last year. And so in general, the behaviors have been relatively the same. The only thing that's changed is the magnitude of them. So in March, a lot of the essentials were what people focused their spend and time on. So you saw things like apparel and accessories and jewelry. All those things dipped in March as people really retrenched and focused on only what was really necessary, and things that were going to help them shift to a shelter-in-place life. Makes sense. Fitness and sporting goods. Can't go to a gym, want to stay healthy, want to stay in shape. You have to figure out how to set yourself up at home, right? So that makes sense why that had a massive spike. But the kind of current trend to see is that as we move into kind of June and July, things have relatively normalized. Those lines are pretty straight, pretty flat. And that kind of tells me that, where we really have landed is that we're going to stay at an elevated level from where we were last year, but we're now reaching a state of normalcy. And obviously things will change as the pandemic changes, if a vaccine comes out, if new treatments come out, as people get more comfortable going back out. And conversely, if we see spikes in cases, we head into flu season and things start to get shut down again, I think we can expect to see, similar shifts in consumer demand. So that's a quick look back and kind of where we are today. And now we want to talk about sustaining growth and how to do it the smart way. And so to start, we figured let's use a modern history lesson. So over the last decade or so, there's really been this kind of buzz about DTC brands and the rise of DTC and all these new brands that are effectively being built overnight. And really what happened is, the market dynamics were such that, there was an opportunity for brands to basically be created from scratch very quickly. Whereas it used to take years to build brand equity, the mass reach of a lot of the walled garden environments like Facebook and Google and Amazon meant that you could reach massive consumers with relatively low costs of marketing initially, and with that mass reach and great targeting that was available. And also you had a lot of VC money flowing in. So there was abundant investment in getting a lot of these brands started with low competition, low advertising costs, and the ability to scale very quickly. So looking at the quote to the left there from the CEO of Warby Parker, Neil Blumenthal, his quote is, "It's never been cheaper to start a business, although I think it's never been harder to scale a business," right? And so that makes sense. Based on those market dynamics, people were very quickly able to build brands, scale them, get them in the consumer's hands. And the VCs in their models were very focused on scale and exponential growth, drive that scale at all costs, right? And so what had happened is a lot of these brands were building their consumer base and building their scale, but their actual cost of acquisition of customers in many instances was negative. They were actually losing money. They were operating the businesses in the red, continuing to rely on investment, an additional series of investments to make sure that they could keep the businesses going as they built scale. And as a result, they kind of took their eye off of the core fundamental business economics. And over time, as competition increased, as more brands came on the platform, as those costs of acquisition went up even further, as it got more and more difficult to maintain that high growth level that was initially started. And so as a result, a lot of brands started to really struggle. Brandless ceased operations, Glossier suspended its cosmetic line after poor sales, Outdoor Voices CEO was forced out after they saw, there was a massive burn rate for the size of their business, because they were just, again, trying to build brand through scale and not really operating a sound business. Now, obviously with the pandemic, the need for things like brandless, and has become more important again. And all these businesses are in flux. They're all still out there. They're also trying to figure out what their next moves are and how do they kind of adjust their businesses and their models and their ways of working to fit the current environment and do so in a way that's going to help them sustain over the long haul. So what are some of the lessons that I think they should have learned, that I think you can also learn through this process, through this rash of recent DTC challenges? Well, first takeaway is prioritize value and differentiation. It's no longer just, hey, here's an inefficient marketplace and the ability to build a brand quick. I can go put something out there that's the next version of X, Y, or Z, right? You have to really differentiate. You have to have some reason for being that adds value to the consumer. So ultimately, don't just be another also ran, right? Be something that truly differentiates and provides value to the consumer. To get a consumer to try your brand, the main three reasons that have been quoted from a number of sources are availability, convenience, and value, right? So thinking about those things as you're looking to think about your brand positioning, those are important to the consumer in terms of why they may want to try a new brand. Number two, develop a brand community, especially in today's day and age with social connectivity being so high, and understanding a lot of what's important to the up and coming generations, and what, as they develop more and more purchasing power, some of those younger generations really do care a lot about the strong sense of values that a brand has, and they want to shop brands that align with their core values. So it's really important you understand what you stand for. What is it that you're doing? It's not just about building a product and selling a product, but why, how, what is your reason for being, and what are your causes that you're driving? Because aligning with your customer base on those core values is going to be extremely important to your future success. Include your brand loyalists in your conversations about the brand, right? Your product design, your feedback, your distribution. They can be brand advocates for you. They can help you get in front of more similar consumers, and really help shape the future of the brand. Especially, again, the younger generations, they want to participate in those conversations with the brands they love. They want to, give you positive feedback. They want to be part of your mission. So figure out how to incorporate them in that process. And then third part of that bullet is corporate and social responsibility or table stakes in today's day and age. You have to make sure you take those things seriously. You have to genuinely stand for the right things and make sure you're participating in those conversations the right way. because in today's day and age, if you misstep around any of those, socially responsible causes or corporate causes, you're at risk of really hurting and undermining all the brand equity that you're building. So very important to keep that, close to heart. Number 3, focus on operational excellence. This means making sure that you're doing everything you can to build profitability controls in place, understand all the aspects of your supply chain, understand everything that's a consumer touch point, understand what you need to do to make sure you have a sound business. And we're going to talk about some metrics that help with that a little toward the end of today's presentation. And then don't just deliver on consumer expectations, exceed them. We're going to talk about the importance of customer service, but if a customer wants to know, hey, I ordered something, I'm going to get it on a certain date, I want to have the tools to check and see where it is, make it easy for them to know, hey, what did I purchase? Make returns easy, make everything that's an operational interaction with the brand something that's easy for the consumer, and it's going to pay off in the long run in loyalty. Number 4, omni-channel expansion. So really you need to think about how you expand the business in 2 key ways. 1, your overall product distribution. So, direct channels that we talked about. If you're just a DTC business and you're selling direct and you're just marketing through walled gardens, you're going to have a bottleneck there for your growth. You're going to max out what you can do to scale the business unless you start doing 2 things. 1, start looking at how you can expand your distribution channel. Yes, with COVID, it's a little bit more difficult to establish retail. But again, as we saw, even looking at beauty as an example, Ulta, Sephora, starting to kind of do buy online, pick up in store, starting to open up certain stores in certain markets, you're going to still want to have that distribution because that gets you exposed to new customers. You have loyal retail shoppers, just like you have loyal e-commerce shoppers. You have loyal direct shoppers. By opening up more distribution, it's going to help you grow your sales by getting in front of new customers and selling to them in the channels they want to buy in. And number 2 is looking to scale beyond just kind of the walled garden environments and your performance marketing channels. Certainly, it's easy to get fixated on, hey, I'm getting great returns for my remarketing. I'm getting great returns for my email. Well, sure, that's low-hanging fruit. That's the end of the funnel typically for most of those purchases. A lot of times you're talking to your existing customers in those channels, right? So it's natural you're going to see higher returns there. But ultimately, if you're constantly just hitting the consumer in those ways, you're going to desensitize them with your direct messaging. You need to start thinking about how you're going to reach them in other media channels. How do you expand your reach? How do you expand your ways of communicating? How do you get into more sight, sound, motion of video advertising and more kind of brand advertising to help you increase your messaging and increase your reach? That's going to help you scale. 5, improve margins through vertical integration. So again, as I touched on earlier, what really happened was you had the ability to go reach mass amounts of consumers, cut out the middlemen by selling direct to the consumer and take the margins out of retail and other operational touch points. And you were able to pass those savings on to the consumer. And the cost of acquiring those customers was relatively cheap because it was still a relatively inefficient marketplace without enough really competition. But those things have all changed, right? Now there's a lot of competition. We have increased acquisition, media costs, and it's getting harder and harder to just pass along savings to the consumer if we do want to do so profitably. So this is where it's going to be important to start thinking about, as I say, vertical integration, really thinking about, how do you start owning more of your supply chain? How do you start owning more of your distribution? Because ultimately, those rising acquisition costs and costs of personalized distribution are going to challenge the business to be profitable. So as your business is starting to scale, taking more operational ownership in-house and improving your vertical integration is going to help. 6, become customer obsessed. Customer service is imperative for brand building. You can find a number of studies on this. You can look at a number of businesses that are succeeding. One of the main reasons Amazon has been so successful is from the beginning, they made it all about the customer. They made it all about making it frictionless consumerism, making it easy for the consumer. And little by little, they became a sleeping giant that became a very visible giant, right? And they built it by being customer obsessed. And you can see a number of studies that will talk about how some of the best performing, publicly traded companies also have some of the best net promoter scores, some of the best customer service scores. And those things are important because ultimately brands who are customer obsessed are going to get more from their customers, going to have more brand loyalty. They're going to see higher lifetime values and be able to build enterprise value more quickly. And then 7, measure what matters. So as we talked about, sure, scale, growth, important to an extent, but doing so healthy and in a profitable way is going to really help the business sustain over time. You need to really understand what your cost of a first-time customer is. You need to understand what your payback is on that acquisition. Understand what the true lifetime value is. If you're just going out and trying to get new customers at a negative margin and losing money, that's not a good business. No one wants to go into the business to lose money indefinitely. So you have to really have your arms around the metrics of what's important fiscally for your business so you can make sure that you're really doing so in a profitable way. Also, important to understand how you're measuring your media, right? So look at the business holistically and all the media and marketing touch points, not just conversion sources like the walled gardens or email at the end of the funnel. And we're going to talk a little bit more about that. So beyond the walled gardens, and by walled gardens, if you're not familiar with that term, it's really saying that those closed channel or ecosystems where, basically all of the communication, data, marketing, everything's happening in one environment. So Facebook, Google, and Amazon being the 3 biggest, most common examples of a walled garden and typically used as, interchangeably with what a walled garden is. And what's great, as we talked about, they offer convenience, an efficient path for initial growth, but over time, brands have to look to other sources to scale. So sure, Facebook, Google, Amazon, they make it really easy, right? Upload a credit card, upload some creative. Here, we're going to give you a bunch of tools to make it easy to make your ads and put them on the platform. Who do you want to target? Here's a whole bunch of data. You know who your customer is. Great. Here you go. We make it easy, turnkey, get to it. And again, especially when the cost of media were a little lower, it was very easy to quickly scale a business. But as we talked about, eventually things get more challenging. As a rule of thumb, businesses will start to plateau once they hit about 20 to 50 million in rev. And the CAC, or customer cost per customer acquisition, starts to become so high that the brand has to start looking at alternative distribution. The other thing that's important to note, the walled gardens, while they, are alluring in the beginning, you have to realize your competition is also there for the same reasons. Because they make it so easy, all advertisers have access to the same targeting, to the same data, to the same audiences. So that means even though you're scaling there, it doesn't really give you a huge advantage as an advertiser, right? And again, because your competition is there competing with you, you're just driving up the customer acquisition cost in those environments. And the third point, although, we like to think that everyone's on social media all day long, or, on Google all day long, or shopping on Amazon all day long, it's just not true. The consumer lives outside of the walled gardens. Even though they do spend a good amount of time there, they still also are reading other things on the web, participating in the open web, going to read and watch videos, read articles and watch videos. And they don't just shop online, they also shop in an omni-channel way. So to continue to scale the brand to reach new audiences, it's important to look at, alternative marketing and media channels, and look at expanded distribution, as we said in the earlier slides. And so that means really kind of thinking through, what is a holistic media plan look like? How do we scale our reach cost effectively? How do we start thinking about other media touch points for the consumer beyond the walled gardens? And that could be anything from audio to video to PR, direct mail, email, print, out of home. Not all are going to be right for all businesses. It really depends on your business and your objective. But building a smart communications plan that knows the right channels, the right roles, and the right media weighting is going to be imperative for scaling beyond the walled gardens. Now, in order to do so, you have to be able to measure, right? How do you know what's working? How do you know what the best channels are? How do you know what the right media weighting should be in terms of your investment levels? Well, it can get challenging, right? And so again, a lot of the reason a lot of brands start and go to those walled gardens, they make it easy. You're just putting everything in one channel, and they're giving you the reporting, they're telling you what's happening, and you see the returns you want, and you put more money into it. They make it very turnkey. But the reality is there's a lot of hidden challenges with doing so, where it's not quite as accurate. One, as we talked about, customer acquisition costs are rising. Two, when you look at these channels in isolation, the performance looks a lot stronger than what it is in actuality. And that's because they're typically overstating, right, what the results are for a number of reasons. One, it overlooks incrementality. Facebook, for instance, reaches a lot of people. Well, who's to say those people weren't going to buy your product anyway if you're pushing ads out to them and they're seeing them and they're getting cookied or tagged from an identity perspective, Facebook's taking credit for that sale. Well, that's going to overlook the incrementality of customers that were likely to purchase anyway, right? 2, duplicate conversions. If people are shopping on Google and on Facebook and they're looking at YouTube videos, I mean, again, the overlap of the scale of these walled garden environments means they're touching most everybody in the United States. So if they're all touching everybody and they're all taking credit for everybody, guess what? You're going to have multiple sources taking credit for the sale and have duplicate conversion tracking. And then the third thing is really misappropriated credit to bottom of the funnel tactics, especially with last touch models. So, if we're looking at all of the different media touch points, if we run, Hulu, connected TV, YouTube video ads, and then someone sees our ads on social, and maybe they see, an at a home ad or read a magazine ad or see a TV ad, and then they decide, you know what, I really like what I saw from those ads. Let me go search for the brand on Google and buy the product. Well, should Google get all the credit for the marketing? No, they shouldn't, because they were ultimately in that example just capturing the demand that was partially created by all the other media touch points. So, it's important that as you start to look to scale the business, you understand how to measure those upper funnel reach and awareness channels in a way that's going to give the proper credit for you to scale your business cost effectively the right way. That can be difficult, it can be challenging, it requires having, modeling and capability. So it's important to invest in those resources, whether it's in-house with your data science teams or, looking and partnering with agencies such as ours. And so just to give a little bit of an example of what that means in terms of how we do that is, at Stella, we use what's called a probabilistic model, Markov chains. And effectively, the easiest way to describe what that is ultimately what we're doing is we're comparing for every media touch point that we can track, what is the likelihood of an outcome happening based on that media touch point being part of the process. So to use a soccer analogy, if we say each player on the field is one of those media touch points, what's the likelihood we'd score a goal with or without that media touch point? So, a lot of times you'll see assists being tracked in sports, and that's because people realize, getting free and getting the assist and passing it to the person that scores, a lot of times without that person getting in position to pass the ball for the goal, that maybe that goal wouldn't have happened. So assists become a very important metric. So effectively what we want to do is understand if we were to take assists for everybody who touched the ball and we were assigned value of the goal to everybody who touched the ball on a fractional basis, so it wasn't one goal, but everybody got a portion of that goal, how would that look? And so ultimately, that's what we do is we run these models to say, if we took that yellow circle, that center midfielder out of the game, how many goals would we have scored if he wasn't in the game versus if he was? And that's ultimately what we do with a probabilistic model, is it really helps us understand what the likelihood or the probability of the event or conversion would be with or without that media touch point. And that helps us assign a better value and a more realistic way of determining the value of your media. And so using a quick example, this is from a retail example, a lot of direct selling and just simply comparing on the right what GA was recording with last touch in terms of revenue attribution versus putting it through our Markov chain process and seeing what the true credit really was and what the adjustments were. And you can see the biggest takeaway here is that direct and organic search, we're getting 62% of the revenue based on GA, but only 32% of that when we look at what was happening through the reattributed model. And so certainly the more you're doing in upper funnel media and awareness media, the more important it is to do these things, because you really want to understand, people aren't able to click on video ads. So if you're measuring things on a last click revenue basis, how are you actually measuring the true value, of some of those other channels? And so this is a great way of going about doing so. Other questions we hear a lot from, the marketers that we work with on the brand side, that we like to think are important are, what return on ad spend can I expect with my budget? How much should I spend to meet a revenue goal? What is my optimized budget allocation across tactic? What yield can I expect? Am I at a point of saturation with a marketing channel? And at what spend level would it make sense to introduce another channel? And so these are all things that we think about. I want to scale my business. I want to figure out what should I spend? Where should I spend it? Where am I going to have challenges? When do I introduce more channels? And so we'll work with our analytics and planning teams to really work with the brand to help them understand. So we've developed our own response curve tool called Spark, and that allows us to really basically understand, for a desired outcome, what do we want from a set of inputs or varying stimulus. So the easiest way to say that in media terms is, we're looking at what are the right investment levels to either contribute to ROAS or awareness lifts. And so using the example on the left, ultimately what you're seeing is, here's an example of just putting together a couple response curves for radio versus TV. We see initially at lower spend levels, radio is driving a much stronger ROI than TV, but over time at higher spend levels, that ROAS starts to experience diminishing returns. Conversely, we see TV is more expensive in the beginning, but based on the heightened shape of the more elongated and taller curve, it shows that there's greater reach potential and impact on consumer over time, and it will last for a longer period of time. So a lot of times what we'll look for is, where is that kind of efficiency frontier lie in terms of the right media weighting levels, right, as we look at different channels. And again, this is a very simplified example using just radio and TV. This is something we look to do across the board. And a lot of times we'll take clients through the process of truly understanding the value of their media through an attribution project, or a market mix project, or a sales lift analysis if you're driving in-store activity, and then try to figure out the right incremental media weightings accordingly. And lastly, we're going to close with some key metrics that we think are really important to make sure you're scaling the business and looking at the finances the right way. And so really, to make sure you have the right foundational understanding of the value of each marketing touch point, you're going to have to really understand which key metrics are driving profitable growth. And so the first metric that's important to understand is the CAC, as we talked about, or customer acquisition cost. What's the cost of acquiring a new customer? So there's a lot of things that will go into that, right? It's not just, here's my growth team trying to manage the CAC, but all the things that contribute to getting that new customer, your media teams, your creative teams, your engineering and UX teams, maybe it's an in-store initiative. All those things are going to contribute to the cost of acquisition. So by improving each of those elements of your operation, you should be able to drive down your customer acquisition cost. Your conversion rate, which is the rate of successful completed event versus the start of that process. And so this is pretty common. Most people understand what a conversion rate is, but drill into it. Maybe you want to look at not just, hey, who came to my page and who actually purchased, or who started my checkout process and who completed it, but look at all of the journeys, who engaged with some of your different media touch points or your email newsletters and came to the site. Start breaking down your conversion rates into more sorts of micro funnels to understand where you have areas of improvement. And that improving each of those individual paths is going to lead to greater overall site conversion. Average order value, so total dollars spent versus the number of orders. It's a pretty easy one. In general, a lot of people will think average order value should be as high as possible. Not necessarily. It really depends on looking at in the context of the business and your model and everything else. So it might be that you find that having a lower average order value leads to higher frequency of purchase, right? And that leads to a greater overall value of the consumer over time, or lifetime value, which we're going to talk about. Gross margin, which is the cost of sales over the gross sales price, right? What is the actual margin of what we're earning after all of the hard costs that go into the product? The packaging, the distribution, the manufacturing and cost of goods sold, all those things, versus the net or contribution margin, which is everything we just talked about in the gross margin, but also including taking out discounts, refunds, everything else. What are the net dollars left after everything that contribute to my bottom line or my net profit, right? So important to really, at a bare minimum, understand those aspects of the business. Then moving to a little bit, some other metrics that are more intermediate, but also important to help understand the efficiency of your marketing and retention efforts. First and foremost is retention. So that's the measurement of continued use of the product or service. So if it's a subscription model, certainly how long do you retain those customers? If you're selling goods or one-off services, what's the frequency of purchase? How often am I seeing people actually purchase over a continued period of time? Am I losing customers? Am I seeing attrition? The payback period, which is the time it takes for a group of like consumers or cohorts to pay back in their contribution dollars the amount it costs to acquire the same group of members. In other words, how much did it cost to get this group of members to come in? And how long did it take for me to earn back the profit, the contribution to pay for that customer, right? What is the period of time that takes? Because obviously the faster you can pay back the acquisition cost, the better, right? And the more profit you're going to earn over time by retaining the customer. And that ultimately leads to lifetime value, which is that cumulative combination, contribution dollars and cumulative net profit over the course of the entire relationship with the customer, right? So what is that customer worth in perpetuity over time, right? And so obviously these things work together in a way that the goal is to increase retention, which is going to decrease your payback period and increase your lifetime value, right? So there's certainly other ways to increase lifetime value, offering more upsell, offering more value, offering new goods and services. All those things will also contribute. And then lastly, these three metrics kind of pull it all together, and they're a little bit more, more business metrics that I think kind of really help you really understand how you're going to profitably, gauge and grow the business. The first you may have heard is lifetime value to CAC ratio. Very simply, it's the lifetime value of a member divided by the customer acquisition cost. So that basically says it's the number of times that the customer pays for itself, their acquisition cost over time. So essentially, it tells you how efficiently you're able to acquire new customers. In general, you want this to be as high as, the higher the better. As a rule of thumb, you want the ratio to be equal or higher to the number of years the person's been a customer. So if it's 3, you want it to be 3. If it's 2 years they've been a customer, you want it to be 2. And the idea there is that, you're getting that customer to pay themselves, off as quickly as possible. Now, certain models or businesses might have a lower ratio because you may say that, we have a very sticky, high cost of changing business, right? And, say the example of like DirecTV several years ago. Now with cord cutting, maybe not. But several years ago, they knew if they got someone to sign up for DirecTV that they were going to stick around for a while. They had a lot of data that proved that out. So they were willing to pay multiple years of contribution margin or to acquire a new customer because they knew over time that was going to pay itself off profitably. That's kind of risky. The sooner you can pay it off, the better. Net revenue retention is the retained revenue net of allowances, discounts, and returns. So really the net revenue retention is able to tell you whether or not your customers are spending less, more, or the same over time, right? So you don't just want to retain the customer and have them kind of like purchase every so often. You want to make sure you're still actually getting this customer to be active and continue to buy from you and increase their value. So looking at that net revenue retention is going to be important. And then even more importantly is looking at that net profit over time. And again, looking at it from a cohort basis or again, common attribute consumers. And that's really a measure of profit that shows that same group of users over time and showing you what that incremental profitability looks like over time. So, these things are good to look at in a vacuum, but it's even better to look at over the course of time to make sure you're taking stock of the longevity of the value you're getting out of your customer base and ways you can improve that. Because ultimately, if you retain the customer, it's going to give you more to invest in terms of new products and services, which is going to add more value to the consumer and get them to purchase more from you, increasing lifetime value and retention. And again, it becomes a virtuous circle of growth there for the business. If we were to take it one step further, and I don't have a slide on this, but I would say if I added one more here at the end, I would say, think about those cohorts from a marketing perspective as well. What are the sources of acquisition of the customer? It may be that you're finding certain channels or certain acquisition efforts are leading to a better value customer, a richer customer, one that's worth more to the business. So you shouldn't have a democratized customer acquisition cost if you're seeing certain things are delivering much more valuable customers. You can start to drill down deeper and get a little bit more sophisticated with how you're measuring your acquisition efforts. So those would be my recommendations. I hope they're helpful to you guys. I hope it helps you, think about profitable growth moving forward. Marley, I don't know if we'll have time for questions. It looks like we might be a little over, but if that's the case, by all means, feel free to reach out. I'm Brandon Heagle, Chief Digital Officer at Stella Rising, and we'd be happy to, get in touch and see if we can help in any way possible.
Oh, that's great, Brandon. Yes, I think you're right. We're a little over time. Thanks everyone for sticking with us, but I know the presentation was so helpful. I know I use stats and figures from these long after the conversation ends. And so I hope this was useful to you as well. I know profitable growth is so important for brands. So it's great that you focused on that today, Brandon. Thanks again. As Brandon said, please reach out directly to Brandon or me if you have any follow-up questions. And next Friday, please do tune in again. We have one more Stella Vision before we take a little summer break and come back hot and heavy in the fall. But next Friday, we have the amazing Rena Yashayeva, our fearless Amazon leader. She will be back and ready to tell us how to get prepared for Prime Day on Amazon. It's definitely a must watch for anyone trying to optimize on the platform. So again, thank you so much, Brandon. Please reach out to Brandon or myself and have a great weekend.
Thanks, Marlea. Have a great weekend, everybody.